Oh, hello. How's it going, GK?
Great. Nice Tuesday afternoon here. How are you?
Absolutely. I am doing well. It is a sunny day here in Boston. I am not freezing this morning, which is nice. It's a change of pace from the past week or so. How are things up in Toronto?
Great. Yeah, things are warming up. Spring's around the corner, like tomorrow or the day after, and yeah,
Yeah.
looking forward to a peak tax season here, and yeah, should be good.
Oh, yeah. A beautiful tax season here.
That's right.
Awesome. Well, for folks who are in the room already, we're just going to give it another minute or two to let any stragglers file in. But again, we're going to be recording this presentation. So if you have any questions after the fact, by all means, we'll have contact info for everybody to reach out for us. But for folks who are here too, we want it to be a conversation. I know I'm going to be doing a lot of reporting at the top and talking at you throughout, but if you have any questions that you really want me and Chike to follow up on, just raise your hand, put it into the chat. We've got folks monitoring the channel here as well who can flag anything up that is critically important, and we will bring it to the floor. But looking forward to a good chat.
Yeah, we got some familiar names here on the attendees list. Hey guys.
See it. All right, we'll give it one more minute, Chike, and then I think we can dive on in.
Sounds good. We got 45 minutes, I believe.
Oh, yeah.
Yep. Yeah, continue. Yep. I'm glad we waited. Yeah, one or two more people joined here. Andrew, Glenn, thanks for joining.
Love seeing names we know on this list. So happy to see you guys.
Yep. You just missed me so much. I think just want to
I
reconnect.
get it, Chike.
Yeah. I
Makes
guess
sense.
I'm pretty sure it's the topic, not the person.
Column A, column B, a little bit of
That's
both.
right. That's right. That's right.
Awesome. Okay, well, folks, we're at the 2:03 mark. We got a lot to discuss, but like I said a minute ago, for any folks who came in after we did our brief semi-intro, this is a conversation. While me and Chike have a ton that we want to share today, we want to make sure if there's a specific issue that you need us to address or that you need some clarification on that you think we might have that expertise on, hit us with it. We are totally open to anything here, but the main focus, again, is 3 survival hacks riding out a VC funding downturn. Now, to get into it, I want to lead off with a quick intro. For folks who don't know me, I am Paul Davenport, and I am the head of content for Boast. So in my role, I help lead the creation of thought leadership content for the team here, which includes hosting our What the Tech podcast, which I hope many of your subscribers on, and also helping moderate webinars like this one here today with Chike. So Chike, I'd love for you to give a quick spiel to the folks in the room. Tell them about yourself.
Absolutely. Hey everyone, Chike here. For those who don't know me, based out of here in the Ottawa/GTA area, back and forth. My role here at Boast is dual-fold. I have a finance background, working with companies raising some non-dilutive capital, and also working with a portfolio of clients here on the R&D tax credit side of things. But yeah, happy to be here. Thank you, Paul, for including me. Everyone, nice to see you guys here. Hopefully, there's some good takeaways for everybody. That's the goal here.
Absolutely. So as you can see here, this is a taste of what we'll be covering today. So along with an intro that I'm about to give about what we do here at Boast, we're going to dive right into the state of VC today and in 2023 to give you some grounding for where the conversation will go from there. Then we're going to look at diversifying your capital strategy. We're going to get real deep into some of that non-dilutive capital and how you can access it at key stages throughout your startup's life cycle. And then we're going to go long on R&D tax credits. That is really where we have cut our teeth here at Boast, so we want to make sure that we can share that expertise with all the folks here in the room. So on that point, a little bit about Boast. So our vision is to accelerate innovation across the world by helping startups unlock the true potential of their R&D. Traditionally, this has involved helping teams gain access to non-dilutive funding as well as R&D tax credits from both the US and Canadian government. But what we really do offer is so much more. We enable startup teams to sync their key project tracking, financial, and payroll systems into a single platform. From there, we can actively help teams tie specific R&D activities to both expenses and outcomes. This streamlines the process for identifying what qualifies for tax credits and ultimately maximizing those claims, while also giving teams access to an R&D system of intelligence to help them better allocate resources, apply for funding, and extend their runway. Now, before we dive into the meat of the discussion, I did want to give a quick primer on what the business community is up against in the current economic climate. Specifically, we want to zoom in on some of the big VC headlines from 2023 and how those conditions are impacting many businesses' abilities to leverage investment funding today. So to kick it off, as rough as venture capital markets may have seemed last year, there's likely to be even less cash to go around in 2024. This is at least according to the latest findings from PitchBook, as startups only raised $76.6 billion globally in Q4 2023. That was the lowest haul since 2017. So fueling the speculation around the climate is the fact that Q4 VC deals also hit a 3-year low point for both volume and value in Q4, marking another steady slide from the venture boom of 2021, where Q4 totals exceeded $2 trillion. So across the entire year, global VC funding fell from $531 billion in 2022 to roughly $345 billion in 2023, while VC fundraising slid even steeper, with firms collecting only $161 billion in 2023 versus $307 billion a year earlier. So globally, Q4 2023 marked the lowest full-year total figures since VCs raised just $119.3 billion in 2015. And this is a far cry from the almost $400 billion that was raised in 2021. So while these funding and fundraising disparities are stark on their own, looking at 2023 on a quarterly basis paints an even murkier picture for what's in store as 2024 rolls out. That's because total deals and deal value steadily dropped throughout 2023, with figures from Q1 and Q2 lifting the annual total despite a downward overall trajectory for both funding and fundraising across all 4 quarters. So in a nutshell, global venture capital firms themselves raise less cash heading into 2024 than in almost half a decade. By default, there will simply be less VC funding to go around as startup seeks capital in the new year. Now, despite VC activity falling sharply on a global scale during the past several quarters, it's hardly all doom and gloom, especially for early-stage startups. In the US, for instance, early-stage companies actually enjoyed a far less tumultuous year than their peers on the global stage. While there was certainly a decline in the median deal value for Series A fundraisers between 2022 and 23, the median deal value at the seed stage last year matched the 3 million record set in 2022. And then to that end, the average value of USC deals actually rose to $1.3 million last year, which only recently happened in 2006, pardon me. And then additionally, while the median pre-money valuation for post-Series A rounds shrank from 2023 to 2022, the median pre-money value of seed deals rose from 11 million to 12 million last year. So while hardly a boom, these upticks for seed stage funding show that investors aren't averse to funding new startups. Rather, they're being more discerning about the funding the latest and greatest tech after perhaps overextending their investments at the height of the pandemic. Additionally, CFOs are optimistic about the US economy, according to a recent survey. The Fed showed that top financial executives predict GDP of about 1.7% in 2024. And this is a big improvement from attitudes just back last August, where they were only anticipating roughly a 1.3% uptick. And now to look at Canada specifically too. The CVCA, pardon me, guys, tracked $6.9 billion invested across 660 deals over the past year. This is a 34% drop compared to 2022, while deal volume declined by 6% year over year. Now, despite the challenges in the face of VC, Canadian businesses, as you all know well, have a wealth of other considerations that should be top of mind. For instance, there's been further delays in enacting the long-hyped CIC, or the Canadian Innovation Corporation. It was originally dreamed up as Canada's answer to DARPA, where basically you would provide government-backed innovation funding for defense initiatives, but it never took flight. The program was reimagined as a Crown Corporation, and in February 2023, when it was I'm so sorry, guys. It was reimagined as a Crown Corporation and was going to absorb IREP back in 2023. but the transition has been hit pause. This won't be happening until at least 2026 or 2027 at the earliest. And at the same time, the government has also embarked on SHRED consultations to find a cost-neutral modernization of the SHRED program. So while details are light on how this will pan out for the SHRED and the broader announcement, including the CIC launch, the government is hoping to buy more time to get better organized and optimize its mechanism for driving innovative homegrown innovation. Pardon me, guys, got a little tongue-tied there. So in a nutshell, cash is tight. Chike, I'd love to turn it to you. What market conditions today, VC or otherwise, are causing the most headaches for business leaders in your network?
Yeah, absolutely. Thank you, Paul. Thanks for the context here. And I think a lot of this, if it's not news to you, it's probably confirming a lot of the things we've seen over the last, I would say 12 to 16 months in the fundraising landscape here in Canada. In terms of, to answer your question, in terms of what we're seeing from founders today, and I think in our podcast with our other clients here at Boast, talking to some of our clients, partners in the space, we're seeing some headaches surrounding, preserving runway or efficiency. Efficiency is a word that seems to be tossed around quite a bit. We saw there was, obviously on the macro level on the public markets, there was, some significant, layoffs from employment. We're seeing that on the smaller scale as well last year. It's not something that is taken lightly, of course. These are headaches, and a lot of the companies that did raise a sizable Series A ticket, those board conversations are along the lines of, tell me about the runway. What have you been doing? What levers have you been pulling to ensure that revenue's coming in, development's on track, but pushing that dollar every inch further, right? So that's a common theme. It's a headache for sure. For everybody in the market, not just investors, but obviously operators, people that have raised or looking to raise, and it goes down to staff too, right? These are people that live here. They're our neighbors. They're us, right? So it takes a big impact to throughout the whole column here.
Absolutely. I really want to drive that point about efficiency home too. Chike, you had mentioned it. We have a lot of our customers on our podcast. We had Lauren Thibodeau from SaaScan on recently, and she was just talking about how the new baseline for runway, just to pick one dimension, it is a lot longer than it used to be in the past. 12 months might have been like good, if not better or best. That is now the bare minimum when a lot of VCs are looking at investment. They're looking at 18 to 24 kind of as table stakes today. And while that's primarily for SaaS, I think that can be applied across many different industries as well. And again, even though every business is unique in its own right, these are just the new realities of 2024 VC funding and then just funding in general. So really just want to drive that point home. We're hearing it everywhere.
That's right. Yeah, great.
Yeah. Now, before we dive deep into the strategy session, I do want to give a little bit of a primer about the fundraising journey, the life cycle of a startup as we discuss it, and just basically what is available to you at the different stages. This is now largely just some scene setting before I pass it over to Chike to really get into the meat of the discussion and share those hacks that we talked about. So to kick things off, it all starts off with that idea or concept. It's the first phase where you identify the problem you're looking to solve and you match it to a solution. The next phase is when you start pulling together the personalities and talent you want to help get your idea off the ground. Next is the phase where you've got your founding team in place and the brain power you need to start creating your MVP solution. The prototype phase is steep with R&D as you test hypotheses and tweak processes to refine a product that really solves key problems. Next, you reach stage 4, that launch beta phase, once your product has been developed and you've turned those test cases into customers. This starts to fold over into the users phase where you'll be refining your product market fit, optimizing your funnel, and molding your channel product fit based on actual market data. It's then at the revenue phase that your product is clicking with users. They're paying for your tools or service, and this revenue starts playing a role in your capital strategy. You can also start expanding your team outside of your core product development shop to capture that momentum and grow your go-to-market strategy. Then your startup has entered the growth phase when you're starting to produce higher revenue while new challenges arise that could ultimately present opportunities for expansion. And then once your startup is involved into a revenue generating machine, it's considered an established business and you're in full-blown profitability phase. That is, you are raising funding based on actual performance, not just market hyper potential. You might even be exploring either an IPO, if not an acquisition. And then that's where many founders reach the exit phase, which, while it isn't pictured here, is more or less where founders have the opportunity to cash out of their venture if the conditions make sense. So with that rundown out of the way, I am going to switch gears real quick and actually turn to the folks in the audience to do some polling with us. Let me just get this set up for us, guys.
David, I see you joined the call. Welcome. Nice to see you.
So thanks for bearing with me, folks. Just want to make sure I'm getting the right screens teed up for us. All right. Now, if folks could please take out their phones and pull up that QR code, we would like to know, having looked at that life cycle kind of diagram that showed where the different funding is available, where do you see your business in this life cycle? When we know what the makeup of the room looks like, we can tailor the conversation from here. So by all means, dive in and tell us where you're at, and we will be sure to focus on that for you going forward. Revenue. Give folks another minute or two. All right, that looks like a good spread.
Yeah, so I would say a little bit more mature, right? I mean, and I wouldn't say, no, definitely nice to see that. Yeah, so kind of, I think, on point for this topic.
Perfect, yeah. Right. Give it another minute or so, but I think that's probably a good read of the room. And I think where we expected for this audience, the makeup to round out. It's not folks who are necessarily building a solution. It's ones who, ideally, in most cases, revenue is playing part of that capital strategy. So they got to be more considered in the sources of funding that they get going forward. There's more opportunities and more risk. Yeah.
Yeah, just looking at that graph, it looks like if you look at that valley, it looks like we're almost at the bottom of that valley and kind of trending up. I think that's kind of where we can focus the conversation. So yeah, kind of exhausted the bootstrapping friends and family angels, etc., and incubators. I know we have some incubators in the room here, but you know, on the verge of accessing some private capital, some VC capital, some venture debt, some more traditional bank operating lines. But yeah, this is great.
Right,
Everyone growth here, yeah.
Okay, we're going to move into the next one. Now, hopefully everyone here is familiar with Shred, but we'd just like to know more anecdotally how deep we should go in giving the 101 and just our big elevator spiel. You researched but never applied. Okay. And again, we'll be covering more than just Shred in this conversation. It's all about the hacks you need to get over the current VC climate and access innovation funding in all dimensions. But we do want to make sure that folks know about what's available here and that we're able to give them the access to resources they need to maximize their claims.
Yeah, and I mean, not to spoil it, but you know, some of the hacks here, I mean, it's really just diversifying. And I think that's one of the big ones I think we'll talk about. You know, diversifying the capital strategy is something that we've been seeing. You know, in the past, I think companies that have raised capital, they're good. That's their one source of investment. And now I think you know, we have companies that have raised capital in the past that maybe for whatever reason didn't care for Shred or IRAP or whatever it may be. And now they're kind of knocking on those doors again, you know, kind of just squeeze every penny that's available that's available, right? So
sweet. And final question. Are you currently taking advantage of grants? Like I said, and like GK just said, it's about diversifying. So not leaning into just one avenue. He mentioned IRAP. That is a very, very popular complementary almost grant program to Shred. Obviously, there's a lot of considerations that go into it. A tax credit is very different than a grant.
Yeah,
You also get access to different resources when you go with IRAP. It's advisory. It is actually getting in touch with
that's
people
right.
from the government. So
Yeah, yeah, we're
they're
big
different.
proponents of IRAP right here. I think most people in this room would agree. It's nice to see that there was a decision to revamp that program and double the budget. I think a common occurrence we hear in the market is that IRAP ran out of money in Q1. So I guess they listened, so which is great. A good start to retool and add some budget to that. Awesome
Absolutely.
program, and we have lots of local ITAs we work with across the region, and have nothing but good things to say about them.
Yeah, absolutely. And like I had mentioned earlier in the state of VC spiel too, while the government has delayed modifications to the IRAP program, there have been a lot of promises over the years. It is happening. It has
Yeah,
been a slow
exactly.
crawl, but it is
Yeah,
coming. Sure, it keeps getting punted to the next year or the next quarter, but they're going to revamp it. It's
yeah,
going to be a lot more, I think, aligned with the kind of innovation that
yeah.
Canada as a country really wants to see too. So that
That's
means
right.
pulling in other programs, pulling in super clusters even. I'm not working in the government, but these are just some things that I forecast coming down the line as the CIC comes along. All right.
So we kind of a split room here on grants.
Split room on grants.
Yeah.
Okay, so we're going to close the poll then, and I am going to switch screens. Bear with me a moment, folks.
I think we have a diverse group in attendance. I think so it'll be good to kind of cover some of the basic stuff, but also rehash some of the stuff that maybe some of the people in this room are already quite familiar with.
Absolutely.
Yeah.
All right, and thank you for letting me fix my screen. But Chika, I'm going to pass it over to you to
Yep.
kind of take the wheel here. I'll move through
Absolutely.
the slides at your command, but yeah, let's dive into some of the
Yeah.
different ways startups raise capital.
Absolutely. So, I think most people in this room have seen this deck before, or similar, kind of bullet points. And I'll run through them quickly. If you have any questions on any of them, please just raise your hand. Happy to provide some additional details on it. But bootstrapping, this is kind of a great buzzword, and it's really what it is, what it sounds like. You're starting a company. It's you yourself, maybe one or two other co-founders, and it's your own capital. You maybe have some savings saved up. Maybe it's from hopefully a previous exit, or maybe it's just some of your own personal savings that you put together to start start the business. And these costs are generally pretty low. Most companies we see aren't issuing themselves a dividend or a paycheck just yet. It's just covering some of the soft costs, laptops, hosting, some of the development track, stack that you'll need to build whatever software or application they're trying to accomplish. Friends and family is exactly what it sounds like. Hey, I have a good idea. I'm going to ask some relatives, some siblings. I'm starting to do this. I'm trying to raise $100,000. All I need from you is five, right? I think something here it's generally a tough conversation to have. It's you're mixing personal with your professional life, but we have seen this to be pretty fruitful. I think generally it's a safe group of investments if people you're familiar with. But again, there obviously could be some headaches in this here as well. Incubators, I see L-Sparks on the call. They'll love to see this. L-Spark is a great place to and invest Ottawa here in Ottawa, and many in Toronto, and across the region. It's a good place to kind of network. Maybe provide some free resources. Whether I know some firms have for instance, a free G Suite hosting for a year. Right now, these aren't cash value, but there is value to the company to gain some of these services. And again, what they're trying to do there is offer some free services, a freemium, if you will, for the first 6 months to 12 months, and hopefully they're able to send you an invoice in month 13 or so. Angel, Angel is, what it sounds like. There's definitely high net worth individuals, whether they're small family offices or maybe, professionals that have, a pretty sizable, investment strategy. and sometimes they like to park a few percent of their net worth into something a little more risky, right? And that's investing in early stage startup companies. Obviously, lots of angel networks across the country. The Capital Angel Network here in Ottawa, but also the National Angel Association (NACO) is also around as well. Crowdfunding, I won't spend too much time on this. I think this is it's there's some stuff online. There's some some services available. Haven't seen a lot of successful traction from this. I know there are some good stories coming out of this, but typically the check sizes are smaller. It's hard to pitch your product and your idea, on a website, and hopefully someone in the world says this is a good idea. Here's X thousands of dollars, right? And of course, the topic of today, venture capital, right? Very, if you understand it in a way, investors, endowments will pull some cash together, write a check or at least commit a set of dollars to a well-established, venture capital firm, and their job is to go out there in the market and find deals to invest in, right? Usually they expect a 5 to 7 year, again, plus or minus horizon for return on their investment. So they're always looking for some sort of liquidity event, right? They want to improve your valuations from today and to month, year six from now. Venture debt plays a little bit similar to venture capital. Really what we're looking there is as the name suggests, it's debt, right? It doesn't touch your balance sheet. It doesn't touch your equity, sorry, your capital table. It behaves in many ways like venture capital. There's a sizable transaction of capital upfront, and it could be dependent on different tranches should you hit certain, let's say, MRR multiples, right? So again, it's a way to offset, a founders group to diluting their shares, but also getting some, I guess some more expensive debt to offset some of those dilution costs. Similar debt financing, kind of very similar to this. It's debt in its layman terms, leverage. Right there, what we're looking for is, look at banks in the market. We're looking at, revenue, cash flow based lending, right? Very traditional, maybe an operating line of, maybe 50, 80% or 10% of your current, MRR projections. And obviously here you'll see here that Paul graciously put in a highlight here and SR&ED funding. We're going to talk about it here a little bit. If you're already receiving SR&ED as a refund, SR&ED funding is not new. It's been around for many years. I would say over the last 10 years, SR&ED funding has become a lot more standardized, right? The days of independent SR&ED firms or SR&ED sharks out there financing at predatory rates I think are dwindling. Now there are well-respected establishments, Boast being one of them, that play in the space that offer some patient and flexible capital. And the last, of course, government funding. Paul touched on this a little bit. Grants of all sorts, could be from colleges, could be from a clean tech initiative, could be from a can export perspective, IRAP, of course, and lastly, but not least, the SR&ED program here, the space that we operate in, and many of you in this room have either researched or already getting these claims done and getting a sizable refund. But yeah, these are all, I wouldn't say this list is inclusive, but these are ways, startups, how they raise capital and how to build a capital strategy. Yeah, next slide here. So we'll talk a little bit about just the types of non-dilutive funding. Non-dilutive definition, it doesn't touch the cap table. If you own 80% of your company and the less of the 20% is owned to, you maybe call it maybe some early investors, maybe some stock options to some of your early employees. The nice thing here is that this capital, it's yours, right? You don't have to give away some of the piece of your pie so early on in this stage. And eventually, if you're looking for venture capital money, you will be giving up some significant portion of the cap table. But until then, they're yours for now. And your aim is to build a valuation so you get the best bang for per share, right? So again, some examples: debt, loans, right? Again, very traditional financing products, revenue-based financing and venture debt. Sometimes, here we put down, it can complement an equity round. So maybe if you're closing a sizable equity transaction, you can blend it, add maybe a few percentages of it into debt. Again, it off risks everybody involved in the transaction, which is sometimes welcome from either the founder's perspective or the fund actually raising the capital into the company. Yeah, and grants, of course, not non-dilutive, right? So it's funding upfront that's for you, and again, does not touch your cap table, and of course, tax credits fall right into that category as well. So we love non-dilutive funding. It's not a binary outcome of which one's better. I think they're both equally as important. I think non-dilutive funding definitely helps you get the best valuation down the road if you decide to exercise any of your shares. Thank you, Paul.
So,
Yeah, and a list of I would say reputable partners in our space that we work with, that we have clients that work with. I'm biased. I came from the BDC world here, so we had to put our logo up there. My previous employer. But yeah, we have relationships with the people on the screen here. These firms we find are the most flexible, right? Not as rigid as a traditional. I mean, we have some of the big five up there as well, but you'll see that certain lenders are behave differently in the commercial space, especially in the innovation space. Yeah, I won't spend too much time on this. There's some acronyms here on the page, but it kind of just this tells you the average, I guess, I don't want to say check size, but the type of commitment each grant or source of non-dilutive funding could equate to, right? As you look at, building this capital strategy, it helps you forecast and understand what's available. The key there that I want to bring out too is I'll talk about one specifically is IRAP, right? Often we hear IRAP in the market is maybe the first check is a little bit small, but that's by design, right? The key there is that IRAP is attempting to build a relationship with you to see if you set out to do this project and you said you did it and you completed it. And they're happy to have a second tranche and third tranche and fourth tranche and so forth, right? If you look at some of the large publicly traded tech companies here in Canada, a lot of them started with a very small check size, right? And that was on purpose, and they all wanted to be built up, down the road in their life cycle. I think if I went here, I think Shred obviously I think is my favorite one. We're biased, Paul and I. But essentially, up to a maximum, the quick math, any dollar you spend in Shred, you're potentially be able to receive up to 64 cents to the dollar as a refundable tax credit, right? So that's CRA wiring you the credit in cash into your checking account. So very happy about that one.
well, sorry about that.
No problem.
All right, so we already covered this one.
Mhm.
And now when these ones become the most valuable. I know we gave a little bit of a primer, but could you expand a little bit on that for us, Chica?
Sure. I think sometimes we meet with companies and the timing is uncertain of when to ask for these, but I think the rule of thumb is on day one, understand what these are available, right? Reach out to these programs, learn about it, build a relationship, and see where you fit. And sometimes, if you go to a super cluster and you're only an employee of one, they might say, okay, well, we only fund 100 employees and up, but at least you have some bearing to what they're looking for, right? For futurepreneur, it's I think we'll talk about it a little bit later. Earlier stage young entrepreneurs, the smaller check size, but you can see here a lot of this comes early on, right? And the transactions can grow should the relationship continue. So again, to that point, starting small, building trusts with these firms. I mean, obviously IDMTC and Shred excluded, is important in this journey to really amplify and really help you out to really ride out the storm, right? We've had scenarios where companies didn't file Shred for many years because they had a $25 million raise, several years ago, but now we're going retroactive. And to your point, it's a good exercise to go back and claim what's available, right? It's an 18-month deadline. Don't get too much into that, but yeah. Yeah, so there's some common hiring and training grants we see in the market. We set a lot of our clients up for this if they should they need it if they're not already into it. I won't cover too much. I think we'll share this deck after the call. Have a look here. There's some nice stuff here. I think they're all worth a while to knock on their door and see what the eligibility criteria is.
Now we're going to dive deep into R&D tax credits and specifically the primer on Shred, which like
Sure.
TK said, we're a little biased here. It's
Yeah.
what we cut our teeth doing here at Boast to begin with.
Mhm.
TK, if you could unpack a little bit about just the 101 on Shred and also how teams
Yeah.
can leverage it throughout the life cycle.
Yeah, absolutely. So from a CRA's perspective, this is a program, for those in the room that aren't familiar with the program, it's a program to offset innovation risk and financial risk on a mission to solve some sort of technical uncertainty. Really, R&D, you're innovating here in Canada, and you don't have to be successful in your R&D. Obviously, from a business perspective, that's ideal, but CRA understands that there's going to be some pain and failure into this development of XYZ product or widget or whatever you're trying to attempt to solve. And what CRA is allowing here is to offset some of these costs in the through a body of a refundable tax credit, right? So there's some eligibility criteria. The bar is, I would say, I think most people would agree, it's set pretty high. And that's by design. It's a large program. I think last 2022, 2021, there was I think $3.4 billion of cash dispersed to Canadian companies. So I think sorry, 4.1. So it's quite. Yes, Joel, you can have the presentation later. Yes. So yeah, it's a great program. The CRA wants to incentivize Canadian companies to innovate, whether that's software or biotech or engineering a new product. Yeah, so again, you'll see here some of the quick math. I won't dive into the proxy traditional methods on this call, but you can see here if you're a Canadian controlled private corporation versus a non-Canadian controlled private corporation, and what does the refunds look like? The most noticeable, you'll see the rates get almost cut in half, but also it goes from a refundable tax credit to a non-refundable tax credit. So a non-refundable tax credit is great if there is, an income tax liability, a corporate income tax liability, then this tax credit is used to set it off. But you can see here, the CRA purposely, sets these parameters up to incentivize Canadian companies, Canadian employees, Canadian employers to innovate, right? We don't mind some non-CCPCs here, but you can definitely see the best return on dollar is reserved for our companies that are based here. Yeah, so some of you in the room here, and I recognize some familiar face names here. We've had conversations about this. There's three main elements to qualify for Shred. Also lead side note, the CRA hosts webinars every 3-4 weeks. I join them just to get an update. They'll definitely dive a little bit deeper on this, but I can give you a quick crash course here today, of course. What they're looking for there is a scientific method to um, develop a new technique, I would say. Okay. What we're looking for there is, in the eyes of the CRA, was there some uncertainty as you embarked on this new project? You're building some sort of software, some widget. What was the overarching problem from a technical perspective, not a business perspective, right? The business logic is important to drive the report, but on a well-written Shred report, the business logic plays a small part. The large part is the technical uncertainty. Okay, well, we had scalability issues. We had regulatory compliance that was unable to it just kind of messed our entire framework. We had to go back to the drawing board, and solutions out there weren't solving our need. Right, I needed an output of 10. I only got an output of 3. Right, so we had to go back and try to move the needle from 3 to 4 to 5. The other two criteria is about content and advancement, right? Like I said earlier, you may not solve your technical uncertainty, but at least you limited the possible solutions to your problem. So from that meaning of definition, the CRA defines as that you learned something from this and you've innovated and then you've narrowed the potential solutions to this uncertainty. Therefore, there is an element of that's refundable, right? This is what the CRA is requiring for these claims. Yeah, so right here, there's industries that are applicable. Ones that are not applicable, maybe I'll talk about that, is usually social services, on the art side, but typically software manufacturing, biotechnology, anything in the STEM related field, typically will have a shred claim. Agriculture's on there as well, and we have many ag tech and ag companies here, and of course, lots of oil and gas companies that are improving, whether that's a business output or maybe a environmental impact that they're trying to improve on. Yeah, we mentioned this earlier. If you're a Canadian Controlled Power Corporation, you can get the refund. As a non-CCPC, you can also claim the non-refundable tax credit as well. Yeah. For those who don't know, you have 18 months to file for the last fiscal year as a deadline. So right now, if you have a December 2022 year end, your deadline is June 30th this year, right? You will incur or waive certain credits on the provincial level, depending which jurisdiction you're filing from. But typically, it must be filed before this 18-month deadline passes. Ideally, for our clients here on our portfolio, we like to have this done within the 6-month mark of each fiscal. This way, you're submitting it with your accountant, saving yourself a dual filing or an amendment filing with your accounting firm. But also in the theme of writing at the VC hack, you also get your refund in faster, right? The faster that BOS can help you get the claim out the door, and CRA can review and authorize and issue the no assessment, the faster the funding's through your door. And cash today is much more valuable than cash 6-9 months from now. Yeah, so a part of the shred component here is documentation, right? On CRA's website, it is important to label that documentation that Paul and Chike worked on this project for this amount of time, and these were the challenges. Documentation is required to solidify the claim. If it's absent, the CRA does have the right to omit any of these expenditures.
So Chike, before we dive into
Mhm.
how Boast does it all, I'd love for us to actually skip ahead and talk to some of the common myths around
Sure,
shred and
sure.
just debunking them. I know a lot of them are points that we've actually already covered in the
Mhm.
conversation, but I think they bear repeating for a few reasons that'll seem obvious when I pose the questions. But
Sure.
for starters, so myth number one, I think it's a commonly held belief that the end of year cramming to collect and analyze tax claim data is just par for the course.
Yeah.
Any tax credit program is going to be a scramble at the last minute. Why is this not the case for Shred?
Yeah, good question. I think this is I think we saw this in kind of why our founders, founded this company. The traditional method is very, very ad hoc. It's after the year end, kind of the fire drill. And I think to my last point, as we're writing out this, call it drier spell of capital, having the claim done as soon as you can, or at least having insight of what's going to be happening on a shred refund perspective is important. Now, this may not apply if you're only, like, let's say 1 employee or 2 employees, but if you have 5, 6, 7, 10, 15, 20 technical employees that are eligible for a refund, there's likely some attrition happening there as well. As a founder, as an operator, you'd probably want to see what's happening with your shred refund from a refund perspective in Q1, Q2. Again, the value that we've heard from our clients is that when they're having these conversations with a VC, an investor, a venture debt firm, they're able to articulate that actually so far we've accrued this much shred, right? This helps our runway. This helps afford certain things for growth. I think this is an important point to bring out, right? I think the days of filing this and having no insight throughout the whole calendar fiscal year are dwindling, right? I think operators demand in a more data of their operations, right? So I think this is definitely one big myth that we still see in the market.
So, all right. So I think there's also a common misunderstanding that an audit gets triggered
Yeah.
because something was done wrong, or there was a violation of some sort that the CRA flagged and you're in trouble. Can you unpack why this is not necessarily the
Yeah, sure. I think this is like a human nature kind of component, right? If I'm claiming too much, I think it's going to raise the flag and it's going to get me an audit. Now, I think the word audit is scary for many people. I think we have to understand that audit rates are high in Shred by design, right? So, understanding that audits will naturally occur. Now, you may not get audited for 10 years, but maybe on the 11th year, you may get picked up. Many people will agree in this space that it's not a matter of, if you'll get audited, it's when. And this is still true today, that we see this often, whether it's talking to people in the market, some of our existing portfolios. The audit there, the mentality there is we want to claim everything that's eligible, right? Again, leaving dollars on the table just because you're a fear of an audit, no, but knowing it's eligible, I think really hurts this downturn of drier VC funding, right? If we're confident in the claim and we have the data to back it up with both integrations and automations, why wouldn't we claim this rightful dollar that's owed to you, right? I think in an audit, they won't, CRA will not lower the claim because they think you claim too much. If you can substantiate it, they will include it, right? So I think that's a key message there.
Absolutely. Now, I do know that we're about at time past the
Okay.
45-minute mark, but looks like folks are sticking around. So as long as everybody's okay sticking with us for
Yeah.
at least the next few more minutes, we got another few points that we really want to cover before we
Sure.
wrap up the show,
And
including
guys,
this.
yeah,
Oh,
sorry, and everyone, if you have questions, put it in the Slido or in the Slack chat here. We're happy to answer them too.
absolutely. And if we don't get to it in the call, we will connect with you directly after the fact
Sure.
as well.
Yeah.
Yeah, but I guess I would love to go on to this next one.
Sure.
So again, I think it's not unfair to assume that tax
Yeah.
credits wouldn't be available for projects that are still in motion, but can
Yeah.
you explain why that's not the
Yeah.
case?
Yeah. So I'll start by saying I would say the opposite is actually true, right? The it's CRA recognizes that R&D doesn't operate on a fiscal year. There's ongoing projects that take time. If you solve it in 6 months, great. I'm sure you'll be working on another project. So it's not specific to one fiscal year. I would say, in fact, some of the strongest claims that even go through a random audit, the auditors have informed us and told us and our clients that it's good to see the history and progression, right? Because they can go back and look at, a company who started in this version. They've iterated for the last several years. Still lots of challenges, but look how far they've come from 2017 to 2022, et cetera. But yeah, good to myth though.
Awesome. All right. And I think this one is actually probably my favorite myth to debunk, but
Yeah,
I think it's also one of the most common ones. Again, it's not unfair to assume that the team's actually involved in driving the innovation.
yeah.
We have the vocabulary to detail this to the CRA. Why is that not the case, GK?
So I'll say this. This could be half true, but I can understand why. You know, at Boastier will usually hire and no, always hire someone with a STEM background to understand the type of work our clients are doing. But at the same time, be able to articulate it in a way that is up to standard for CRA's reviewers and auditors, right? So while you may have a very experienced PhD holder in computer science at your firm, right? They've likely only written very few shred reports and been in very few, if not zero, CRA audits. So there's a balance here of skill that is required to articulate these technical write-ups and obviously articulate a conversation in the event of an audit. There's mechanisms that are employed to ensure we have a high audit success rate, but also a robust written claim, right?
Yeah. And this last point, I think we did touch on already about why or why not it's not essential that you complete your project within the fiscal year that you're qualifying for shred. It's all about learning. And like you had even
That's right.
mentioned before, failure is a key element of all of it.
Yeah, I won't spend too much time on this slide, but yeah, failure is, the running joke is failure usually equals some sort of success in shred. Okay, from a shred perspective, it's not and businesses don't start businesses just to claim shred credit. They're trying to solve a problem, whether it's a service or a product. But yeah, definitely failure is definitely a good starting point, especially if you've never filed shred before. For those in the room, this is one of the first questions we'd like to ask, right? We want to understand. Tell me what you and your dev team or your development team swore the most, and I think from there we're able to uncover some of the failure and challenges that are eligible for a refund.
Absolutely. Yeah. And so I moved. Yep. So we already covered these eligibility slides previously.
Yeah, that's right.
I did want to go in a little bit about
Yeah,
quick and the shred
sure.
fund that we talked about earlier.
Yeah. So again, this is, I would say maybe one of the hacks, I would say, if you're already leveraging, if you're already accessing the shred refund credit, um, why not leverage against it, right? If you're expected to get a return of a couple $100,000 at the end of tax time, why not access some non-dilutive capital? So it's a kind of think of it as a non-dilutive capital on non-dilutive capital multiplier, right? At Boast here, we can fund quarterly accrued refunds. This helps our customers, I would say extend runway, provide some, a more comfortable working capital position, right? Again, these are all, I guess thumbs up or things in the good column when they go to raise or talk to an investor, right? I think now with the investment landscape, investors are it's slimmer, right? They're a bit pickier, right? And if a firm or an applicant or a potential portfolio company is able to show that, hey, we have a very strong working capital position, we have a nice stack of capital options that, from a non-dilutive perspective, we have a shred refund, a history of shred refund coming in, but we also leverage certain aspects. I think this might, again, I'm not going to put my words in an investor's mouth, but I think this sharpens the pencil for you guys as operators, right? You're able to show that we don't really need you right now. We have funds and we have a nice capital stack strategy that is efficient, and we've accessed these programs. We know what we're doing, versus having none of these on the table and just solely relying on a venture capital injection, right? Sometimes it does work, but we like to play kind of in the middle of the column here, right?
Absolutely. Yeah. And
Hmm.
Chike, I will double down on that. From all the founders that we've talked to on our podcast, even they have mentioned that just even having a shred qualification in your back pocket is a bona fide
That's
when
right.
you're going to talk to investors, when you're going to talk to VCs. They want to see that you're doing your due diligence to be a savvy investment,
That's
that
right.
you're stretching your dollars further. You're making the most out of every dollar that they're throwing at you. And that includes working on innovation that's going to drive market differentiation, explore white space in the market. It just compounds and it's a virtuous cycle from there. And yeah, again, it just shows that you are doing your part in engaging with your investors as well.
That's right. Yeah, I think, yeah, I couldn't have said it better. I think that's efficiency is key in this, writing out this landscape. Right.
Absolutely. Yeah. And here's another quick little recap about our Quick Fund program and how we help with the funding of
Yeah.
Shred. But again, folks, I know that we've gone a little long, so I am going to move to this screen that has our contact information up there. But again, if anyone in the room who's stuck around for us past the 45-minute mark has any questions, we're all ears.
Yeah.
And
I'm here. Yeah.
again, if not, too, feel free to interrupt me while I'm filling the air, but we will get back to you directly either on email or on LinkedIn if you do not feel like raising your voice in this conversation here. Reach out to us at either of these email addresses here or, like I said, on our social channels.
That's right. Thanks, Paul. Yeah, thanks everybody for attending today. Appreciate the bandwidth. Tuesday here on about an hour's block. But yeah, I think some closing thoughts here. As we look at 2024, I'm hopeful for the future. I look at the public markets. It seems like they've been pretty healthy, and usually it could be a leading indication of what's going to be trickling down to some of the private markets. But the common theme, like I said, efficiency. What else have I heard this year? Doing more with less, right? I think the days of the pandemic hiring and the pandemic spending is coming, back down to earth. Maybe to an equilibrium. And I think if you have a business model that showcases this, I think you'll attract the right investors, right? I think this is an important part. I think I see one Q&A here. Oh, hey George. Oh, thanks for saying that. Yeah,
Gonna say it's a kudos, Chike. The best
yeah,
kind of
absolutely.
question. Yeah.
Yeah, exactly.
Awesome. I think you
Yeah.
put that well. And Chike, I'm just gonna echo what you said too. As doom and gloom as a lot of it all looks, you can kind of pick and choose your headlines and find a storyline that fits into your scenario. So if it seems tough out there, you're going to hear voices that say it's tough. But also, if you're optimistic, come to webinars like these ones with Boast, or actually seek out founders in your ecosystem who share that optimism, because some of the biggest unicorns, this is going to sound corny, but they come out of times of economic hardship, out of VC investment downturns. It's the ones who have been forced to be scrappy and to seek out alternative sources of funding that have the
Absolutely.
grit to really make it for the long term. So yeah, it's tough, but you're in good company. That's my takeaway.
I agree. I agree for sure.
Awesome.
Yeah,
Well,
and if anybody wants that CVSA report from 2023, happy to share it. It's a nice little read. Maybe it's I think the reader they're trying to aim for is maybe on the investors side. But I think that's great context, as those are the ones that are going to be potentially writing the check or sending you a term sheet. It gives you a little insight of what they're looking at, and in terms of what their competitors potentially are thinking about. But yeah, reach out to me. My email's there. I'm happy to share that with you on a PDF document here. Yeah,
absolutely. Yeah.
yeah,
And also stay tuned to the Boast blog as well, because like I said, I am a stats junkie. So I love reports like the CVCA one. We've sprinkled some of those stats into recent posts, but our goal is to take those conversations and take those news items and make them actionable for folks in this room, for folks in this audience. So again, reach out if you would like the report. Chiki will furnish that over for you, but keep an eye on all the resources coming out of Boast as well. We're translating it into action items that you can take with you to help you weather any of these market conditions. Great. And I think we'll leave it at that, Chike. Thank you
yeah,
so much. And thanks again, everybody.
yeah. Thanks everyone for making time. Nice seeing some familiar faces, and I hope to just connect with you guys in a little later time here.